Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and analyze all the macro markets and all the macro moves. Today, obviously, it's a little more quiet as I'm not sitting inside of a coffee shop recording, or I'm not sitting outside and recording some videos. So today we get some nice and quiet background noise, which is obviously a little good. The dollar index has had a pretty nice decline from its previous high at around 79.50. I did highlight that it was a double topping pattern. We had a nice little pullback, but it's very doubtful that this pullback will last very long, mainly because we're seeing doubts across the world, mainly amongst asset managers, analysts alike, including myself, that we don't really think these markets are very sustainable, as in the European issues or the European crisis has become very, very unsustainable. Once a country gets to a 7% bond interest rate, it becomes very unsustainable for a government to pay back their obligations. A 7% interest rate, I mean, my own mom and brother can get a mortgage at a 5% interest rate. So if Italy has to borrow money at 7%, there's something clearly wrong. I mean, people in the United States, just average citizens, can get a loan for a 5% interest rate on a 30-year loan. I mean, let's give me a break. It's just a 10-year loan and you got to pay 7%. I mean, you know, that's clearly ridiculous. So again, these governments have basically failed at managing their money, and they're getting the punishment they deserve for doing so. And quite frankly, I mean, yeah, it might not be very fair for the Italian citizens. You know, I mean, if I was an Italian citizen, I'd be, you know, quite infuriated at my own government and its inability to govern. But again, that's a totally different topic. Right now, the US dollar index has had a nice little pullback on the one-day chart. Kind of have a little bit of a pullback before we're heading a little higher, floating a little higher. The Asian session has been very weak. The Nikkei is down negative 1.34%. It's currently trading at 8,363 points with a negative 103 point change. The Hang Seng Index is down at around negative 342.87 points with a negative 1.88% change, and it was last trading at 17,913. And the China Index Composite is at around 2,356.33 with a negative 56.07 point change, and it has lost 2.32%. So Asian session has been relatively weak, so we can anticipate weakness in the European session and the US session going into the Tuesday trading session. I've already positioned my positions relatively short this market. I'm short this market completely. I'm not long. I don't have any outstanding long position in any high beta stock. I'm primarily short this market. So again, that's some quick disclosure right there. Let's go ahead and analyze the Dow Jones Industrial Average. First of all, it goes right into that 50-day moving average before going back, and basically I was anticipating a small little bounce into that 50-day before heading lower. Based on the market action we're seeing abroad, I can see this market heading lower and retesting that bottom 11,200 area. Based on the short term, based on how short this little bounce was, basically this bounce only lasted for a couple days. It's very, very unlikely that this market will be able to find support back at 11,200. This is kind of a key market principle that I kind of learned from some key technical analysts. But what kind of happens is that when a market gets a small bounce off a support area, and then it retraces up a little bit to hit a moving average, and then it comes back lower, that's typically called an A pattern. But another thing to consider is the short brevity, the short amount of time that this market has been able to stage a small bounce before heading lower. Those are called dead cat bounces, A patterns, whatever you want to call them. The shorter the duration of the bounce and the retest of the support, that short time span, the shorter the time span, the less likely it is that area will hold, and the higher the likelihood of us breaking right below 11,200. In this case, the likelihood of us breaking below 11,200 is more than 50%. So again, based on foreign market action and based upon what we already know, these markets are headed lower, and we have a strong downtrend in place just based on what we're seeing on the trade triangle technology. We got a weak negative 85 score on the stock indexes. So that's a quick background on the whole entire market indexes, how they're trading, the strength of the trend, which is very strong to the negative side. Foreign indexes are performing very negatively into the Tuesday session, which translates into U.S. weakness or U.S. Weakness. Weak hands in the U.S. trading session. A lot of blocks, lots of blocks of stock will be sold on the Tuesday morning. Let's look at the NASDAQ composite. It wasn't able to get back up to that 50-day moving average. We're kind of trading at around, give or take, 2,515. Let's go ahead and look at that real quick. We kind of touched that gap fill area right there, that gap area. You guys can notice right here, this is a gap basically between this area and this area where there's no trading done, and that was kind of a move between different trading sessions. Yes. We kind of went into that area, we kind of touched it, and then we pulled back. This is typical technical analysis. The areas you really have to watch out for are your gap areas, your Fibonacci retracements, and your major moving averages on the daily charts, along with previous areas of major support and resistance based on major events that have happened in the past. For example, here is a good area to consider for support. Here is a good area to consider for resistance. Okay, and here's another good area to consider for resistance. And then you're going to look at that 50, the 20-day, and the 100-day moving average. Now, I know my lines aren't exactly straight or anything, but you guys get the point that when we trade markets, there are key areas you have to watch out for, and those are the gaps, those are the Fibonacci retracement areas, and the major support and resistance areas, and the moving averages. That's the best way to trade markets, folks. But for right now, we're still in a strong downtrend, and we're going to go ahead and analyze it based on the trade triangle technology, and boom, weekly move, we're weak on the weeklies, and we're also weak on the monthly. Now let's go ahead and try to find where the last monthly was sitting at. Get rid of the weekly. Yes, there we go. The monthly, the negative monthly, was instituted on the middle of June. We had a nice little bounce from there, but the monthly still held, and we're continuing to go lower. So again, there's so many indicators that are kind of pointing to weaker market movements. I don't really use stochastics that much. I don't really pay attention to them that much. What I do focus on primarily is price action and economic activity. And right now, we have so much negative information and negative news coming out of Europe. I find no reason for us to be buyers of stocks at all. At least on a macro basis. Gold is having a nice little run up on that, off of that 50-day moving average. And this is kind of driven by the dollar index and its recent decline. You guys see that nice little 1-2 dub step to the downside. You know, four candlesticks to the downside. Let's kind of analyze what happened to the gold chart. Yep, 4 consecutive strong sessions on the gold market. So you guys kind of see what's going on here is that the gold market and the dollar market like to move inverse to each other. That's just the way these trading algorithmic principles work. These trading algorithms trade based on this methodology because primarily it works, and it also influences market behavior because it's also a part of the market itself. Because remember, when we trade, and this is based on the 1993 Nobel Prize winning economic theorist. I forgot the name of the dude. There was a movie based on him. But basically, we technical analysts and we technical traders, along with fundamental traders, trade based upon how others are going to react to said market behavior. It happens in all forms of economic reality, but in the case of markets, it is very, very proven to be so. So this whole entire technical analysis thing was proven by an economic professor many, many years ago. I had to look into his theory again and kind of elaborate on what it basically said. But his theory on economics proves that technical analysis is a very valuable means of analyzing markets because we are reacting much more favorably, or we're reacting a little bit faster to the available market data, so that therefore we can make profit before someone else, because we're anticipating a response from them, but we're acting prior to their response so that we can capitalize on an opportunity before they can. And I don't anticipate gold to be able to move much higher from this area. As you guys can go ahead and see, gold has had just too much move. It just zoomed too high to the upside. And right now, all the events that are taking place in Europe are very deflationary, depressionary. I couldn't really recommend gold based on said fundamentals because, again, gold has to depreciate when the total nominal value of currency goes up due to a shrinkage in total nominal currency in Europe. Remember, when governments are unable to pay back their bond obligations, it leaves the bond investors no choice but to liquidate their bond portfolio at a loss of par value. Therefore, when people are saying is 10 years down the road, what a lot of analysts are thinking about is, well, typically this whole entire model would work if the government would pay us back 10 years down the road. The only problem is that we're not sure if Italy, Spain, Greece, Portugal is able 10 years down the road to pay us the full coupon value of the bond note. And assuming that they can't do that, these bonds ought to depreciate at a very rapid rate. And let's also factor in the downgrades or the bond rating downgrades that have just happened from S&P, Moody's, and Fitch. So not only have these bonds downgraded, the viability of whether or not these governments can pay back their bonds have downgraded, are also being questioned as well. So all things considered, if these governments default, that's the total free floating currency will shrink immediately, therefore leaving us with less currency internationally to buy gold, which means gold should depreciate in proportion to currency. Not necessarily will it depreciate in proportion to perhaps food. Like gold may be able to retain value better than watermelons or tomatoes or coal or water. You know what I'm kind of saying here is that gold will depreciate in proportion to the dollar, but it may be able to hold its value against other basket of commodities a little better. Okay, and this is kind of hard to understand, but you know, if you're an analyst at a major Wall Street firm, and probably some of you watching this are, you kind of understand what I'm talking about because you more or less went over this in economics class. But again, let's move on to the next chart, which is silver. Silver, not a big fan of it. Don't buy it. I wouldn't short it either because silver is so volatile in nature, and the amount of leverage you can use to buy this commodity up is absolutely ridiculous. I just wouldn't touch that commodity. Okay, now I don't really have that much time left in this video, so I'm going to go ahead and talk about the rest of it in another video. So take care, folks. I hope you guys have a great trading session on the Tuesday session. You guys have a wonderful day, and don't buy stocks. I anticipate much more weakness over the next couple weeks. Take care.